Welcome back to episode 10 of the $100 to $10,000 series, where I invest $100 every month to the S&P 500 index fund until it grows to $10,000 to show everyone that you don't need a PhD or be a millionaire to invest successfully. This week, we are up 1.52% and overall up 9.55%. And this week, the second quarter of 2020 has finished, and it was the best quarter for stocks in the last 20 years, with the S&P 500 rising over 20% and the tech-heavy Nasdaq rising over 30% in the last 3 months. This unprecedented rise in stocks in an unprecedented financial crisis was made possible largely because the Fed has been so supportive in keeping companies afloat. Most recently, with the $250 billion CARES Act, the Fed has been buying company bonds, which are essentially debt issued by companies to fund their operations. The Fed hasn't been buying every company's debts blindly that ask for it, but in order to get support from the Fed, the companies need to have investment-grade ratings, meaning they are less risky loans for the Fed to lend. And once the economy recovers, the Fed will make money through interest payments on their loans, so it's really a win-win situation for them. And the US Bureau of Labor Statistics released the latest jobs report, where total employment rose by 4.8 million and unemployment rate declined to 11.1%, as a lot of states reopened earlier in the months, with jobs in leisure and hospitality rising by 2.1 million. But these numbers will probably decline in the next month's report as states are reclosing businesses with rising new daily cases. And I came across an interesting statistic that I wanted to share with you guys, and it's that the performance of the stock market 3 months before the election has a strong correlation on the presidential election's outcome. So the idea is, if the market, namely the S&P 500, is in the green 3 months before the election, the incumbent party usually wins. And if the market is in the red, the incumbent party usually loses. And this method of predicting has been accurate 100% since 1984 and 87% accurate since 1928. And of course, correlation does not imply causation, but it is still a very interesting statistic, and it is true that economic conditions do have an impact on these elections. As for IPO news, there is a company called Lemonade Inc. that IPO'd this week, and its stock price soared more than 139% in the first day of trading, giving it a market cap of $3.8 billion. So, what is this company and why is it so hot? Lemonade is a company based in New York, founded in 2016, that uses artificial intelligence to run its home and renters insurance business. The main appeal of Lemonade's insurance product is that everything is done super fast. They claim it takes 90 seconds to sign up and get insured, and 3 minutes to get your payment. This everything done instantaneous model is targeted towards the younger generation of homeowners and renters, which is an untapped market with only 41% of millennials having renters insurance. And the company further tries to appeal to the younger public by allowing the customers to choose a charity of their choice when they sign up to donate to if there are any unclaimed money left in their account. So the company is really trying to get rid of the greedy insurance company image and replacing it with a strong social advocacy image. And it has a lot of people convinced, with investments coming from Google, as well as the AI-focused Son Masayoshi's SoftBank, which was the first video I made on this channel, which I will leave a link in the description below. Looking at the numbers, Lemonade reported revenue of $67.3 million in 2019, which tripled from $22 million in 2018, but with a loss of $108.5 million that doubled from a loss of $52.9 million in 2018. So the company does have a fast-growing revenue stream, but also a growing loss. So Lemonade seems like an interesting company to keep an eye on, but it seems like prices are way up in the clouds at the moment because of its AI-focused business model. Next up, Uber is reportedly trying to acquire Postmates in a $2.6 billion deal. Uber did try to acquire Grubhub in May of this year, but it backed off after failing to reach a deal satisfying both parties, and with rising antitrust concerns as a merger of Uber Eats, which has 22% of the food delivery market share in the US, and Grubhub, which has 23% market share, would create a company that would rival the leader in the industry, DoorDash. Instead, Grubhub was acquired in a deal for $7.3 billion by Just Eat Takeaway, which came about when the UK-based food delivery app, Just Eat, merged with the Dutch app Takeaway, which happened in April of this year. And the deal with Uber and Postmates will most likely draw less antitrust concerns, as Postmates only has a market share of 8% in the US, and if Uber was to acquire Postmates, combined, the two companies would only make up 30% of the market share. But at the same time, there is news that Postmates is getting ready for an IPO itself, so we'll have to wait to see what happens. That's gonna do it for this week. Don't forget to like, subscribe, and comment, and I'll see you guys in the next video.